cannot control the yields on the long end of the bond market. They're no longer controllable. And the fact that we're not tied to a gold standard, which is provides a severe limitation on inflation, if you like, the way prices behave, that doesn't happen either. So, this is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it, but not under a pure fiat currency. That's the point I'm trying to make. And I think that is why we're coming to the end of a fiat currency era with everything that implies.
In today's news recap, gold stuck in a range as trade optimism and Fed signals cap upside. Gold has been stuck in a range for the past 5 days, struggling to regain momentum after falling around 10% from the record high of $4,381 reached in October. The yellow metal remains under pressure after 2 straight weeks of declines, with uncertainty over future U.S. interest rate cuts and easing trade tensions dulling its safe haven appeal. Bullion's weakness comes despite the Federal Reserve's 25 basis point rate cut last week. Fed Chair Jerome Powell's comment that further cuts were not a foregone conclusion tempered investor optimism and lifted the dollar, weighing on gold. That cautious tone, echoed by several Fed officials, has seen traders scale back bets on another rate reduction in December, leaving gold struggling for direction. The situation in gold and silver has been the classic sell the news. As we pointed out in our channel right after major media covered the rally, it's been pretty much flat, which is great for stackers to buy more. For the same exact reason, I'd be very wary of citing any bankster promoting gold and silver now, because they're the ones looking to take the other side of the trade. The outlook was further dampened by easing geopolitical tensions after U.S. President Donald Trump and Chinese President Xi Jinping pledged to reduce trade barriers during last week's meeting in Busan. While the talks stopped short of a full trade deal, the framework for tariff reductions and increased Chinese imports of American goods helped calm markets and, in turn, capped demand for gold. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
I think part of the answer to that is that if you look at the level of debt in the United States, I mean, the US government's debt is about 115% of GDP. The ability to pay that comes out of the private sector, the taxes, if you like, that the financial and non-financial sector provide to the government. That's the important thing. Now, if the economy goes into recession, then that impairs the ability to cover those, to cover the interest cost, and indeed to service the debt. And that basically is what we're seeing. I mean, I put out a piece this morning, and one of the charts in there was the interest on debt. And I tell you, it's scary. It's just, I mean, it sort of goes along like that, and then, it's done that. That, if you like, is really what's happening with the debt trap. And that's why this can't be muddled through anymore. This is coming to an end. I mean, it's actually as simple as that. You need to look at the whole thing in the round. The idea that we can continue to run high levels of debt. I mean, the other thing is that, we did have higher levels of debt. Most countries had debt to GDP of 160, 180, 200% at the end of the Second World War. But the difference then was that we were on the Bretton Woods gold standard. And that kept interest rates down, and it allowed for the expansion of credit, which was angled at production more than anything else. So it was inherently non-inflationary. So what you had was the ability to do yield curve control. That was the time of yield curve control. And you could also persuade investing institutions to act in a certain way. There was all this sort of, if you like, off-the-record briefing of institutions. So, but that cannot happen now. It just does not happen. You cannot have yield curve control. You cannot control the yields on the long end of the bond market. They're no longer controllable. And the fact that we're not tied to a gold standard, which is provides a severe limitation on inflation, if you like, the way prices behave, that doesn't happen either. So, this is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it, but not under a pure fiat currency. That's the point I'm trying to make. And I think that is why we're coming to the end of a fiat currency era with everything that implies. Various economists have said that not one man in a million understands money, including, I would say, those economists. That's probably being a bit harsh. But I mean, the fact is that you need to understand the difference between common law money, which is final settlement, and that is precious metals, gold or silver or whatever is accepted in your jurisdiction, and credit. All the rest is credit. And this was said by John Pierpont Morgan in evidence to Congress, I think, in 1912. Gold is money and all else is credit. And he's absolutely right. It's still true, despite all the propaganda that governments throw at us. If you understand that, then you have got, if you like, the basis of beginning to understand what is happening to the value of credit and how it is likely to proceed from here. And I dedicate myself, and through my Substack, to educating people about this. And to, if you like, rubbish, if you like, macroeconomics. Macroeconomics is not a science at all. It was invented by Keynes on the back of his general theory. You've got to actually understand money and old-fashioned classical economics. And if you do that, then you have got a very good chance of protecting yourself from some very violent financial times ahead. So my mission basically is to try and educate people so that they can survive it. It's a time when you protect your wealth.
In today's news recap, gold ticks higher as focus shifts to U.S. private payroll data. Gold prices firmed on Monday, holding above $4,000 per ounce as investors hunkered down for U.S. private payroll data due this week to assess the chances of an additional Federal Reserve interest rate cut this year. Gold is in the process of carving out a trading range, maybe in the high 3,000s to the mid 4,000s. This is a kind of expected consolidation after such a big move, said Marex analyst Edward Meir. The metal, which has gained 53% this year, has dropped over 8% from a record high hit on October 20th. Now, you guys, it's pretty clear that narratives are shifting from buy now, before it's even higher, to it may go sideways for a sustainable period of time. Investors are awaiting the release of ADP U.S. employment data due on Wednesday and ISM PMIs this week for cues on the Federal Reserve's policy direction. The U.S. government shutdown has halted the release of key economic data, including from the Bureau of Labor Statistics. The Federal Reserve last week cut interest rates for the second time this year, but Chair Jerome Powell said another cut this year was not a foregone conclusion. Traders are now pricing a 68% chance of a rate cut in December, down from a near certainty last week before the Fed meeting. Non-yielding gold thrives when interest rates are low and in times of economic uncertainty. Gold's pause still looks like a breather, not a breakdown. Seasonal softness, temporary Chinese policy noise, and a firmer dollar explain the short-term retreat, said Ole Hansen, head of commodity strategy at Saxo Bank, in a note. Meanwhile, China ended a long-standing tax exemption policy for some gold retailers on Saturday, potentially setting back a buying spree for the precious metal in the world's biggest consumer market. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Well, when Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different. Everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement, and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt, without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which has been funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks. And bear in mind, they've got 16 trillion invested in US stocks. I mean, the whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that. And when it comes to bonds, well, you don't want to be invested in duration. I know that insurance companies and pension funds look at matching, if you like, duration with their liabilities, of course. But as much as possible, you want to go short on duration. I think that's desperately important. And then what will happen, I think, at the end is that your position in gold will actually rescue all the other positions. And that's where you've got to get to. You don't have to have a huge amount of gold to get that. You don't need 20%. But get in there because, as I said earlier, if you look at a 1% increase in gold in global portfolios, that equates to a demand at current prices of 25,000 tons, and it is not there. It's quite simple.
What do you think of today's show? Do you believe that the current gold and silver sell-off is some sort of coordinated attack against the metals, or on the contrary, is just big players taking profits after an abnormal rally? Post in the comments section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, peep this video right here because it's a perfect fit for you, and I'll see you on the other side.